Good afternoon, distinguished Mr. Krishna, Dr. Peng Wensheng, Dr. Xin Ziqiang, dear friends from the press, dear friends from online. Good afternoon. I sincerely welcome to you all to this event co-organized by IMF and CF40. Together, we are going to release the Regional Economic Outlook, Asia and Pacific by IMF. Joining us are experts and friends from Xinhua News Agency, CGTN, and other press outlets. And the event is live streamed at the WeChat official account of CF40 and other live streaming platforms. First of all, I'd like to give the floor to Krishna, Director of the Department of Asia and Pacific IMF, to release the Regional Economic Outlook. Krishna, the floor is yours.
Thank you very much. Good morning to everyone, or good afternoon. In my talk today, I'll talk a little bit about the regional economic outlook for Asia and Pacific and touch upon prospects for China and our policy advice over the next couple of years. So global growth is expected to decelerate and bottom out in 2023 as rising interest rates and Russia's war in Ukraine weigh on activity. Global inflation is easing but remains stubbornly high, and banking strains in the US and Europe have injected greater uncertainty into an already complex landscape. Despite the somber backdrop of a challenging year for the world economy, Asia and the Pacific remains a dynamic region. So these are our latest growth forecasts, which were released during our spring meetings in April. Domestic demand in Asia has so far remained strong despite monetary tightening, even as external demand for technology products and other exports from Asia is weakening. Growth in Asia and the Pacific is projected to increase to 4.6% in 2023, up from 3.8% in 2022. This reflects an increase of 0.3 percentage points compared to the projections we had made in the October Regional Economic Outlook. The biggest driver of Asia's upward growth revision this year is China, while other emerging economies in the region are on track to enjoy solid growth, though in some cases at slightly lower rates than seen in the last year. In Asia's advanced economies, growth will slow this year to 1.6%. This is about 0.4 percentage points lower than what he projected in October. Now, based on this growth forecast, what it implies is that the economies of Asia and the Pacific are expected to contribute about 70% of global growth in 2023, which is significantly larger than we have seen during the past few years. And again, from the chart, you can see that trend continues for some time. So 70% with China and India contributing about 50% together. Now, what is this? What explains the revisions to our forecast? And here, let me point out that China's reopening has boosted growth prospects. The Chinese economy is expected to expand by 5.2% this year. And data from the first quarter have confirmed our forecast of a dynamic start in 2023, with a strong rebound in consumption. At the same time, the property sector is recovering more slowly and is expected to remain subdued, and that's shown in the chart in the middle. Looking forward, PMI surveys are showing a strong expansion of activity, with the recovery expected to be led by services. Again, you can see that on the right-hand side chart, with the yellow line showing for PMI services. And this provides momentum for near-term growth in the region. The upward revision to Chinese growth by 0.8% in 2023 is our largest in this edition of the World Economic Outlook. We see this boosting growth in the rest of Asia as well. Typically, a 1 percentage point increase in Chinese growth leads to an increase on average of about 0.3 percentage points in the rest of Asia. Normally, the strongest spillover from China would be from its demand for investment goods. But this time, the biggest effect is from demand for consumption. We estimate that this will generate stronger spillovers to the region than we've seen in the past. Again, you can see the the implication of the consumption rebound of the rest of the region here in the middle chart. For sure, these spillovers from China will have heterogeneous effects to trade partners across the region. The boost will vary according to their exposure to Chinese demand for consumption and investment. For example, countries that export final goods to China or those that depend on tourists from China will stand to benefit a lot, while those economies that mainly export raw materials to China are unlikely to receive a strong boost from China's recovery this time around. So again, you can see the difference in the impact of the consumption-led rebound in China in the middle chart, and the fact that tourism will play a big role for the rest of the region, for countries in the region. Now, one question which a lot of people have been asking me is about the spillover from the global financial turmoil. And our bottom-line assessment is that the spillovers from the global financial turmoil is limited. Direct exposures of Asian banks and investors to Silicon Valley Bank were minimal, and equity prices for Asian banks have been resilient, having largely made up for the initial losses following the global sell-off at the time of the failure of Silicon Valley Bank. And you can see that in the chart on your left-hand side. There are even some signs of losing financial conditions in the region. As markets reprice the path for the federal funds rate, the US Treasury yield curve has fallen substantially. This has led to a strengthening of Asian currencies and falling yields on Asian local currency bonds. And you can see that in the middle and right-hand side chart. That said, there are still pockets of private sector stress that may be emerging due to factors such as increased leverage and risks from the real estate sector. Asian financial systems should be able to withstand these stresses, being well capitalized and with strong liquidity buffers, but financial supervisors will need to be alert. Now, what are some of the headwinds to growth in the region? What we see is weakening external demand and the tech cycle being slow. This will weigh on activity. So one factor that is weighing on the short-term outlook for the region is the weakening of external demand, with the US and Europe expected to have weak import growth in 2023 and 2024. In recent data, this is putting pressure on Asia's exports of manufactured goods. The slowdown is already manifesting in a moderation of demand for technology exports from Asia to the US, with orders for semiconductors having slowed substantially. And you can see that in the middle chart and the one on the right-hand side. That, in some sense, summarizes the outlook discussion. How do we see the risks for the region? Now, there are quite a few risks to the region, and the first one being inflation, which could be more persistent than expected. Now, as commodity prices recede, headline inflation has been easing, but remains above target in most economies. There is a risk that high inflation could be stickier than expected. In the US, for example, markets expect inflation to remain above the Federal Reserve's 2% target over the next 5 years, and assign a substantial probability to inflation exceeding 3%. You can see that in the left-hand side chart. Core inflation has become a more important driver of headline inflation in Asia, and is proving more sticky as output gaps of Asian economies are either closing or are already closed. Strong demand from China's reopening could prevent commodity prices from declining further. These factors suggest that the battle to contain inflation is not yet over. And yet, monetary tightening has slowed down or paused in most countries in the region. Given the still substantial inflation risk, we think monetary policy in Asia and the Pacific will need to remain tight until inflation falls durably back to the target. The exceptions are China and Japan, where output is below potential and inflation expectations have remained muted. The other risk related to inflation is expectations about the future path of US monetary policy, which has been shifting. So a related risk comes from the US monetary policy. Market expectations for the future path of the federal funds rate have been shifting in recent months. There's almost a disconnect between how markets view the Fed's action and how the Fed sees its own actions. And that's reflected in a substantial gap between market pricing and the latest guidance provided by the FOMC participants, which will need to be closed at some point. This volatility is also seen in recent movements of the US Treasury yield curve. which shifted up abruptly in the first months of the year, only to fall notably since the collapse of the Silicon Valley Bank. The shifting yield curve reflects differing market views about the short and medium-term prospects for the US economy, including concerns about the US debt ceiling. And this could have significant spillovers on the region. If there is additional tightening from US monetary policy, it would have global spillovers, including to Asia. Our estimates show that Asia's GDP, and particularly investment, contracts sharply following US monetary tightening. It would also put pressure on the region's exchange rates, and depreciation would put additional pressure on domestic price inflation. Our analysis finds that exchange rate pass-through is stronger when inflation is already high, as it is today in many Asian economies. If you look at the right-hand side chart, the middle section, you can see that when inflation is high, the pass-through is also higher. So given where inflation is today in the region, we expect pass-through from depreciation to be higher, and that could have a bearing on inflation prospects going forward. Now, there are differences, and again, when we talk about risks to the outlook, one we talk about is Japan's monetary policy could lead to global spillovers. And how does that work? Now, there is uncertainty around the direction of monetary policy in Japan amid a rise in inflation. Japanese government bond yields have increased notably since October of last year. Changes in Japan's monetary policy that led to further increases in government bond yields could have global spillovers through Japanese investors who have large investment positions in debt instruments abroad. So you have Japanese investors who are abroad. If yield in Japan increases, they're likely to repatriate or likely to bring back investment to Japan, and that could lead to higher yields across the world. So that could be a spillover risk to the region. And finally, China's structural growth deceleration and geopolitical fragmentation could affect Asia over time. It's important to consider how shifts in the global economic landscape could affect Asia over time. Over the medium term, we expect the Chinese economy to experience a slowdown in productivity and investment, which will lower growth below 4% by 2028. This may have profound adverse implications for the rest of the region, given their strong linkages to China. In addition, we see that the global economy we see a risk that the global economy fragments into trading blocks. If this happens, the larger exposures will be to Asian economies that currently export significantly to the US and Europe, and those that are currently part of global value chains that see them export intermediate goods to China for use in Chinese exports. These challenges call for the implementation of structural reforms to boost long-term growth. The region should prioritize reforms that boost innovation and digitalization while accelerating the green energy transition. Now, let me conclude the presentation with a few slides on the policy advice we have for China. Again, I want to differentiate between the near-term policy advice and the more longer-term policy advice. Now, what do we have in terms of near-term policy advice? Given a still negative output gap and the prevalence of near-term downside risks, our view is that it will be important for macroeconomic policies to support the recovery. This is why we recommend fiscal policy to remain neutral, avoid premature tightening, and monetary policy to remain accommodative in 2023. But it is not only the level of support that matters. How it is delivered can affect its effectiveness. Structurally reducing precautionary savings and boosting consumption will require strengthening a social protection system. For a long time, we've been arguing about the need for the Chinese economy to rebalance more towards consumption-led growth and away from investment-led growth. And that is what we are talking about here. So when we talk about fiscal reforms on the expenditure side, towards rebalancing, but also make fiscal policy a more effective macro stabilization tool going forward. This is because in China, where infrastructure investment faces diminishing returns, the effect of fiscal support on growth, that is the fiscal multiplier, is highest when the support is geared towards households that need it most. In other words, you need a rebalancing of the Chinese economy away from investment and towards consumption. And to do that, you have to invest more. You have to restructure fiscal expenditure towards supporting households so that consumption gets a boost. As we show in the green bars in the chart on the left here, the fiscal multiplier from means-tested transfers is of around 1.5, much higher than the multiplier from infrastructure investment. So over the last so many years, there's been a lot of focus on infrastructure investment, but what we are saying here is the multiplier related to consumption is about 1.5. When you have means-tested transfers, that multiplier is significantly higher, so you want fiscal spending shifting towards in that direction. And as with fiscal policy, how monetary policy is implemented can also matter for growth. About a decade ago, the PBC began a gradual liberalization of interest rate regulations and implementation of a price-based monetary policy framework which sought to maintain short-term risk-free interest rates within a defined interest rate corridor, right? So how should that be modified? So despite that, there was a reliance on interest rate changes remains very low in international comparisons. And this is especially true since the onset of the pandemic. So this is shown on the right-hand side chart, which plots a 3-year rolling sum of changes in policy rates. The red line corresponds to China, where it's almost flat-lining, and the light blue shows the 10th to the 90th percentile for other emerging markets without currency pegs. In work published as part of the 2022 article for consultation, we show how interest rate-based monetary policy has a larger effect on investment in China, and that this effect is driven by a larger impact on smaller firms. So our advice is not just to have monetary policy be more accommodative, but make it through, having it through changes in interest rates. So this is our advice for China in the near term. So keep policies more accommodative, but there needs to be a rebalancing of the economy, which will be supported by a shift in fiscal policy towards means-tested transfers that would boost consumption and help rebalance the economy. Similarly, on monetary policy, have monetary policy work through interest rates that would be more effective. Now, going beyond the near term, we talk about achieving high-quality growth in the medium term. And what do we mean by that? Once the boost from the reopening fades, and not unlike for other countries, China's growth will return to the pre-pandemic trend and be driven by structural factors that, as I've argued in a few slides before, should lead to a marked slowdown. So we do have a bounce back in growth right now, but over the next few years, over the medium term, this growth will slow. And so you need reforms which could help address that slowing. So higher medium-term growth that is also consumption-driven is well within China's reach. In particular, what I show on this slide are the results we published in the 2022 China Staff Report, where we estimated the effects of a budget-neutral recomposition of fiscal expenditures towards households that starts in 2023 and supports a reduction of the excessively high savings rate and rebalancing towards consumption. So that's the first thing. So you have a refocusing of fiscal towards boosting consumption through fiscal policy which I talked about in terms of mean-tested transfers. The second is implementation of SOE reforms that help close the productivity gap between state-owned enterprises and private enterprises, which will help improve resource allocation and deleveraging among SOEs, while pro-market reforms improve business dynamism. So you want to narrow the productivity gap between the state-owned enterprises and the private-owned enterprises, and you want to do that so that productivity goes up and helps boost potential growth. And finally, the last is labor market reforms that gradually lift the retirement age from 60 for male and 55 for females to 65 overall, and education reforms that further improve access to and enhance the quality of education and therefore boost human capital. So you want to increase both the supply of labor and the quality of labor. So all these three should help address any markdown in potential growth we have. The comprehensive set of structural reforms could boost China's growth by around 2.5% over the medium term and 18% over the long term, as we show in the blue bars of the chart on the left. Is it blue or green? Okay. Growth would be more inclusive, with the private consumption share of GDP rising by 18 percentage points by 2037. As we show in the chart on the right, higher growth also means the debt burdens will be lowered significantly, making for an overall less risky growth path going forward. Let me stop here. Happy to answer questions later. Thank you.
So thank you very much. Thank you for your speech. So before the comment, and now, first of all, I want to share with you some of my points. I have read this report too. I think I was very impressed with the 3 parts, because for several years, this is the first time we can see IMF have come up with good news of China, because it has been lowering their expectation for Chinese economy. But this time it has tuned up. It has shown the vitality we have in the APD. So if you look at the EU and the US, you can see there are many bad news. But by reading this report, we can see that it's still the Asia Pacific has more potential. According to the IMF data, 70% of the growth this year come from Asia, and 1/3 from China, 20% from India, and another 20% from other APD countries. So the vitality of the APD has been very important to offset the the gloomy economy of the world. And the second point is about the resilience of the Asia Pacific economy. So, for example, in the report, many people have been worrying about the Federal Reserve and the interest hike of the ECB and their impact or outflow of the capital, financial stability, or the depreciation of the currency. But all these concerns have not come into reality. Our financial system is very stable. The capital flow we still have the net inflow into the Asia Pacific. We have also observed that some of the bankruptcy in Europe and States, but in Asia Pacific, we have a very sound financial system so far, which is especially unique and valuable. The third point I want to say is the importance of China and how unique China is. The importance of China, because the key of this report is pretty clear. The tune-up of the economy is because of the higher expectation of China, the forecast and the spillover of China to other countries, which is affirmative of the role of China. In this report, it has also mentioned many of the concerns, for example, the high inflation, the possible inconsistency between the monetary policy and the financial stability, currency. Well, none of this exists in China. The reason for that is that our economic cycle is different from other countries. So this is also good news for the world economy. So that is some of the preliminary points I want to make. Now I want to invite the member of the CF40, the chief economist of the CICC, Peng Wensheng, to make the comment. So thank you very much. Krishna, thank you for your presentation and the forecast. So I think I can feel the same as Kai, that for Asia Pacific, I think we have a very promising future. And for China's growth, the expectations or the forecast on China is also one of the highlights of this report. I also want to share with you some of my thoughts. In Krishna's presentation, the China's growth for Asia Pacific and for the world is very important, of course. And naturally, the question comes to, so this year, what will be the GDP growth of China? We can see IMF said like 5.2. Well, the 5.2, if we compare it with the market forecast, it seems to be a little bit lower because for CICC, we think it will be 6. So, first of all, I want to comment on this. So this year is unique, but of course every year is unique because it's different from the recovery historically because we come back from the pandemic with the extremely low base from the previous years. So 6% for China this year in normal years seem to be high, and 5.2 is not a bad number. But we couldn't forget that last year it was only 3%. So factoring that into our forecast, into the average growth, so we think that it could be a bit low for this number. And also after 3 years of the pandemic, hypothetically, the potential and sustainable growth in China has not slowed down significantly. Then, from 2019, if we have everything business as usual, and this year, even if we have a 6% of the growth, the total output is lower. So that is the first what I want to mention. That is the uniqueness of the pandemic should be factored into the forecast, no matter it's about 5% or the 6%. I think that this forecast number is not very high for China. And also Kai mentioned the outlook of IMF has talk about the inflation and other problems. If you look at the number today released by the NBS, the CPI 0.1, PPI minus 3.6%, both of which have been lower than the forecast. So we have also noticed that the unemployment rate, although it has improved, but among the young people, it is still about 16%. And if you look at the PPI and CPI and employment, so the economy still have the potential to grow. The potential, the accumulated effect of this output has been obvious. So I think it is lower than the previously forecasted output. So that's why I want to say that 5.2 number, I think this number is a little bit low for China. Second one, if we read this report on the policy recommendations, so my feeling is that it's very logical. The policy recommendations are very conservative. But compared with a 5.2, which I think is a bit low, I think that the policy recommendations may support it because they are related. Because your focus is not that high, so when you give the policy recommendations, maybe it's also a little bit conservative. But if we want to aim higher for the growth rate, what shall we do? What more aggressive policy actions we shall take? So personally speaking, I think on the fiscal policy, I think IMF is very conservative. You mentioned it is about a budget neutral policy stand, but neutral means that the impact on the deficit will be removed. So that means the structural fiscal deficit will be the same as the last year. But based on what I mentioned, no matter it's about the CPI or the employment, you can see that we have our growth is lower than the potential output. So the demand is very weak in China. So how can we stimulate the demand? We need to use either the monetary or the fiscal policies.
For monetary policy, we have taken a lot of measures, including structured monetary policy. It's very similar to fiscal policy, but it's less effective than fiscal policy. So in my understanding, fiscal expansion would be more effective to support consumption. So I agree with IMF's outlook about the need for transfer payment to support the underprivileged people so as to unlock their consumption potential. In terms of the scarring effect of COVID-19, we talked a lot about the impact on the supply side, but on the demand side, there are also two scarring effects. One is the burden of debt. In the past 3 years, we have relied on credit expansion to hedge the headwind, and this will have lasting impact on household spending. And the second one is about unemployment rate and weak spending by poor households. In this context, the timing is very good to adopt more aggressive fiscal policy so as to heal the scarring effects and unleash consumption potential. Last but not the least, IMF also talked about the need for structural reform in the mid-run. And that will have some important implication for Asia-Pacific. CICC has done some research and released papers on this topic as well. Despite difficulties such as the aging population, geopolitical fragmentation, Sino-US tension, and disruption of the supply chain, China still has an undervalued advantage. That is the economy of scale. China has a huge scale of the market, and we have a well-designed division of labor. All the sectors can work together to create a strong synergy. Now we are stressing scale, economy of scale, because we see signs of deglobalization. For semiconductors, and even the fall down of Credit Suisse, the potential is limited for future participation in the international division of labor. So economy of scale becomes even more important. Secondly, in the age of digital economy, to support China's mid to long-term growth, we need to fully utilize the economy of scale in China so as to maximize and optimize division of labor. Of course, we also have some distortions in the market, such as imported factors, monopoly, and so on. We need structural reform to address these negative factors to promote fair competition and international cooperation. By doing so, we can have positive spillover to Asia-Pacific and the whole world. Thank you for your attention. Thank you, Dr. Peng, for your comments. I observe some difference between your opinion and that of IMF. We will have continuous discussion on that later. Now I want to give the floor to Dr. Xing Zhiqiang, member of CF40 and the chief economist of Morgan Stanley. He will join us from online. Thank you, Kai, for your introduction. This is a learning opportunity for me. I listened very carefully to the presentation by Krishna. Frankly speaking, I got the last-minute call to attend this event. But still, this is a great opportunity for me because I can learn a lot about China's economy. And this year is most special given ongoing changes in the international community, banking turbulence, monetary policy trajectory in the West, and geopolitical fragmentation. In this context, IMF is still confident in the economic outlook in the Asia-Pacific region. This is very encouraging to all of us. As mentioned by Dr. Peng and Kai, this is very different from the tone of the past few years. IMF used to be very cautious in its regional economic outlook, and there have been many rounds of markdown in the growth outlook. This time, it's very different. So now about the outlook on ex-China Asia-Pacific. It seems to me that in addition to China, other economies can also contribute a lot to the world economic outlook, world economic growth, such as India. For example, after temporary slowdown, India has also accelerated its consumption growth. And through structural reform, India will also create more momentum for growth. So in Asia-Pacific, there are other highlights. Foreign enterprises are very interested in India and ASEAN economies, despite the banking turbulence from US and Europe. People are more positive about Asia-Pacific because of moderate inflation and even actions to cut interest rates. So financial condition is easing in this region. In contrast, in Europe and USA, policy rates and treasury yield have increased a lot. But Asia is a different case. The banking sector is generally sound. Secondly, some countries have benefited from industrial chain reorganization. Other countries are engaged in reform to improve business environment, and they will continue to benefit from these initiatives. We have strong consensus on that. But there is one issue for debate. That's about the recovery outlook in China. IMF's outlook is 5.2%, and then the market consensus is 5.5% and even higher. For entrepreneurs and investors, I think people are still doubtful about this outlook. So the foundation of recovery is still weak. We need more policy to support the momentum. At the end of last year, we believed China's growth would reach 5.7% in 2023. So Morgan Stanley was a little more positive than the general market. But the current development is consistent with the previous projection for China's recovery. Many institutions have revised up their outlook on China's growth. Amid all this positive outlook, we should be more pragmatic and cool-minded in our evaluation. Despite some highlights in the first quarter, we also see some signs of concerns and vigilance. So we need to strengthen the foundation for continuous recovery. One concern is about the deviation of macro data from micro perception. The second is about the divergence or the debate between inflation and deflation. And thirdly, given the weak demand and stagflation in Europe and the USA, what will be the outlook for China's export sector? Generally speaking, the decoupling between micro and macro perception is related to the weak base last year. For example, the total retail sales has grown by over 10%, largely due to very poor performance in the same period last year. China's retail sales is not back to the normal trajectory yet. During the Golden Week of May 1st holiday, we have a lot of good news in terms of retail sales, hospitality consumption, and so on. But still, the total spending is only back to the level of 2019. So we still have a legacy gap of the past 3 years to fill, because normally we have a robust annual growth for the service sector, and every year we generate about 10 million new jobs from the service sector. Yet in the past 3 years, we have accumulated a lot of legacy gap in new jobs and spending growth. We are just back to the level of 2019. We still have a long way to go to create new jobs for the young people. So the current growth is still of recovery basis. And to create more jobs for the young population, we need to resume the growth pattern or the growth trajectory before COVID-19 for the service sector. And the second debate, as I mentioned, is between inflation and deflation theories. Krishna talked about the fact that we are not so much concerned about inflation. For many of us, with low inflation, the foundation of consumption growth is also weak. With little growth in household income, the potential of consumption growth is also limited. As I mentioned before COVID-19, the service sector created 10 million jobs every year, and the job creation potential is shrinking from the manufacturing sector. The annual capacity is only about 1 million jobs from the manufacturing sector, far from enough to accommodate new graduates from universities and vocational schools. Yet, in the past 3 years, because of the confluence of factors, we couldn't create adequate jobs. As a result, we have about 27 million so-called implicit unemployment. After reopening of China's economy, some stores are opening up again, yet the stimulus policies are not aggressive enough. We rely mainly on the organic recovery of the market entities. This helps to mitigate inflationary pressure in China. But on the other hand, to create jobs for the 27 million legacy unemployed people, it will take a very long time. This is the major concern about inflation-deflation debate. And the next concern is about China's export sector. Generally speaking, the growth will weaken in U.S. and Europe, and demand for export from China will also be weak. China has engaged in industrial upgrading. For example, EV and lithium battery have become very important exports from China. And secondly, because of geopolitical tension, China is also changing its export landscape. For example, China is shifting to ASEAN countries, Middle East, Latin America, and other emerging economies to boost exports. Data from the past 6 months show that China's export to ASEAN countries, BRI countries, has helped to partly hedge the downward pressure from Europe and USA. Going forward, how can we sustain the growth potential, including the industrial chain of the new energy industry? We need to take measures to stabilize the geopolitical relations with the West.
So there are challenges from all these sectors. So that's why after the Q1 data released, many international organizations and researchers have raised up their expectations and forecasts. But we need to be calm. We need to be very realistic and look at the Q1 growth, especially on the policy side. I think that for the service sector, we still have a 3% of the gap. We still have a lot of the unemployed young people. And in the future, considering the geopolitical tension and export pressure, so then I think policy recommendations are very clear. First of all, for the private sector, we need to create a very friendly environment to help them to rebuild their confidence. So whether there will be the milestone event which will clearly send the green signal or green light to the private sector. Because in the past 3 years, we have seen that in many sectors, there have been the regulatory improvement, but sometimes the policy changed very fast. So entrepreneurs have lacked of their confidence on the policy changes. So for example, for the industry which have already been consolidated and regulated, whether their business has got the new license in the new regulatory framework, whether they can attract the investment and have expanded their business. Because I think many people are still wait and see. And recently, that the AI technology, like the ChatGPT, has received a lot of attention. Many of the leading Chinese companies are trying to participate in this innovation. On the other hand, they are also very worried because the policy have changed a lot in the past few years, whether there will be a stable track of the policy. If you want them to get into the new sector, new area with a lot of investment, whether the policy framework will be transparent enough for them to be confident to get some return for the future. So on the policy side, I think there should be more strong signal from the government for the consistent policies in the future. Secondly, in the geopolitical session, I think China should be very practical and realistic. So currently, China is not only strengthening its tie with the Middle East, Europe, and others, but it is also necessary to find the opportunities to talk to United States, because many of the foreign companies are very interested whether China and the U.S. have released or eased their tension. So some practical manner will be very helpful. The third one is related to the high-quality growth. So from the central government to the local governments, the decision makers should have a reasonable expectation of the economic challenges. Like I said, we do have a lot of resilience in the export, in manufacturing, and there are a lot of the service on site. But it just back to 2019, we didn't catch up with the past 3 years. So a lot of the young people are still unemployed. When creating jobs for them, if you only rely on the manufacturing, there are less jobs available for them. So it can only provide 10%, less than 10% of the new jobs. We still need to heavily rely on the service sector to create jobs. The high quality growth, whether it means we can encourage all kinds of the service sector rather than the high-tech industry. So I think this will be very important to restore the confidence of the private sector to create more jobs for the young people. So this is my focus on the midterm and long term. I think from Kai and Dr. Peng and also the IMF, the presentation today, I think we have learned a lot. But I think that we also need to be very cautiously optimistic. Okay, thank you very much, Mr. Xing. Now we come to the Q&A session. Question